Hi everyone, and welcome to the EcoInvestment update for February 28th, 2016. Spring is in the air, but as if to taunt us and hold it back, we've got an extra day of February on this leap year. So March doesn't officially begin until Tuesday, and then it's, you know what, it's only 3 weeks, less than 3 weeks to spring, and I am excited. Anyway, it was, things got pretty dull over the last week as the markets unfolded pretty much as I expected it to. We came in, had a little bit of a attempt on Monday in the stock market to roll forward, and then we kind of hit a soft spot there. We had a couple, I think at the maximum point intraday, coupled with the day before, we were down about 450 to 500 points off the recent rally high, and that was that good entry point I told you that would probably be a good place to get into the market. And if you did, you're sitting pretty right now. You're long the market, and the only thing you have to worry about is if the market cracks through that, I guess it was 16,200 level. Well, you want to be gone, but you know the upside could be 17.5. So why in the heck not? But for me, myself, and I'm scooting in and out and not taking a lot of time to stick around because I don't trust the market. I think the economic statistics are on a deteriorating curve here going forward. We've seen the car companies just getting their heads handed to them. We saw, Walmart admitting that they're having trouble in retailing, and the chairman of Sears, Kmart Sears, Eddie Lampert, coming out. And Eddie Lampert made the most boneheaded investment in the history of the world when he bought Sears and combined it with Kmart, because he's done nothing except lose hundreds of millions of dollars per quarter. And it's interesting, he came out last Thursday and said, you know what, I blame Amazon, I blame the online retailers because we've had to charge sales tax and they didn't have to charge sales tax. Well, I tell you what, Eddie, they keep their stores cleaner. They have people that actually know what they're doing. Me, so when I order online, I know what I'm doing. I can do my own research. But if you go into a Sears or a Kmart store, you look around these days, it's like Death Valley days, okay? And you don't see anybody around. And God forbid you should have to ask anybody in the hardware department a germane question about what this is or how that works, or do you have any advice on this? It's like, get out of here, So it's no wonder retailing is falling on such hard times. The number that I also keep an eye on, and I've told you about the 10-year note, the 10-year bond, the U.S. government 10-year note. I think that's a critical one. We're still about 1.75, somewhere around there. I've talked about gold, and we're doing pretty good at about 1230, 1240. We're not giving a lot back here, okay, in the marketplace right now, despite this rally we've had. So that tells me there's still people buying here, and they're not rebuying. They're not thinking about how confident they're feeling. They're using any weakness as a chance to buy. So we still continue to see weak statistics coming out of China, and I think some of those markets like Hong Kong and Singapore, those real go-go real estate markets over there, they're really starting to crack now. Throw on top of that the probably over $100 billion to $400 billion of energy debt that's going to go bad or is in the process of going bad. And you have a bad brew for a really rising bad debt worldwide. So we shall see. One of the interesting phenomena about debt is when it goes good and junk bonds get upgraded and things are going better in the economy, good times beget good times in the credit markets. In other words, when the times are good, you can bet that a lot more issues are moving up in quality ranking than down. And the result is the economy runs a lot smoother because nobody's second guessing the quality of what they're holding because times are good. It's easier to pay off money you borrow. But when times go bad, the spiral begins and bad debt begets bad debt. And how does that happen? Well, let's take the oil and energy sector, for example. When you're out there drilling and you go to the bank and say, look, I've got this property here, I've got $10 million of my own capital, I need to borrow $60–70 billion. Here's the seismic 3D work, here's what we think is down there. And they say, okay, we're going to lend you $60 million at 8.5% interest, because it's speculative, right? It's drilling. Well, out of that, of course, you feed the stock of companies like pipe suppliers, right? The oil pipe stock. It takes miles of drilling stock, sometimes thousands and thousands of feet to get down in that. You can imagine the pipe suppliers. You also have drilling mud. You also have crews on there. You can imagine the ripple effects when things start to go bad out of just the price of oil, and debt starts to fall on debt, and then housing in those areas gets affected, the local businesses start to get affected, and it just moves out like a ripple. Well, we've got several ripple zones around the world now. We've got China, which is a huge ripple. We've got Asia, which is a ripple. Europe is I don't even know how to begin to describe a lot of the problems that the ripples that are flowing out of Europe and things, but it's a really toxic brew. You put Japan on top of it, you put the energy and commodity deflation, and we're at a prime period now for a lot of debt to go bad, and perhaps this is why the banks have just been absolutely mauled the first quarter of the year, because not only do you take away their ability to make money by having zero interest rates, but you also inflict a rising tide of bad debt on them to be written off. So it will be very interesting to see going forward. So this will probably be the week and next week where we'll see if this market has any guts to it to propel its way forward. If we go down again hard, we'll probably go down significantly further. If we rally and we can show some strength in buying in the face of selling, well, we could have a pretty decent spring coming up. We shall see. Keep an eye on gold, keep an eye on the 10-year note, and keep an eye on the US dollar too. That seems to be on a weakening trend against even supposedly weak country currencies like Japan. I will see you next week. Enjoy the end of February, and thanks so much for watching. And your comments are always welcome, and thumbs up are appreciated. Thanks.